Okay, welcome everyone to another webinar brought to you by OptionSlam.com. November 4th, 2024. Get out and vote if you haven't already. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors. We are not registered investment advisors. We do not provide investment or financial advice, nor do we make investment recommendations. Instead, we provide these webinars for educational purposes only. And I do believe they're educational because I get emails from people telling me that they get more and learn more from these free webinars that we provide to you at OptionSlam.com than they got from the $5,000 Learn How to Trade Options program that they bought from some trading guru on the internet or off of YouTube or whatever. I am Marco. This is my email address, optionslam.com@gmail.com. Please shoot me an email, optionslam.com@gmail.com, with your questions, your comments, or your suggestions. With that, we will move on to the webinar. And there we go. And all right, very good. So here we are at the optionslam.com website. Last week, I didn't get, listen, if anyone has any stocks that they would like to have me look at and evaluate and, get them typed in the chat there. Get them typed into the chat box, please. Any stocks that you're interested in having me look at, evaluate? Do you have a strategy you're thinking about playing this week on an earnings event? Get it typed into the chat box. I'll take a look at it. Let's take a look at what happened last week. Now, last week I didn't get to all the stocks that people sent by email. Okay, thanks, George. We'll take a look at that. But last week I didn't get to all the stocks, but we did cover in depth, and I ended up going off on getting into depth on a bearish. We had a trader who was bearish on PayPal. That trader has been right on lately, calling direction on stocks without mentioning any names. That trader was bearish on PayPal, so we looked into. That trader did not have a strategy in mind, just was modestly bearish on PayPal. So we looked into some possible strategies. What we ended up with, I thought I wrote it down here somewhere. The strategy that we ended up with. Here it is. Okay, found it. All right, let's go look at the strategy we ended up with. And let's, before we get into that, if you have any other trades, VRTX. Okay, we'll take a look at those. Let's look at, I want to demonstrate our back testings tool. And I'm going to do it by putting on the trade that we initiated. So, or that we illustrated, I should say, last week. So if you go to the backtesting tab and go to OSBTT, you can put your stock symbol right here, and the stock symbol was PYPL for PayPal. And let's see, last week's, let's see, we gotta go see, when would we have put this trade on? Now we did illustrated the trade, I think the trade, let's see, second here, Option Slam, and open that in a new tab. Let me go back to Option Slam and let's find out when the proper time, because sometimes we illustrate trades when it's not really the right day to put the trade on. I mean, we have the webinar, and then if it's a through the earnings strategy, we don't want to actually initiate the trade until the day, the hours before, the final hours right before the announcement is made, if it's an after the close. Let's see, PYPL, PayPal. For example, let's see, PayPal announces before the open last time, okay, before the open last time, and 83 gap down to 78. So all I did here is I typed in the symbol up here, and that brings me to the PayPal earnings history page right here. I have all these other pages I can look at, but the earnings history page tells us what happened. It was October 29th, and that was, let's look at a calendar here quick a minute. October 29th was Tuesday. Well, our webinar was Monday, the 28th, and they're reporting the 29th before the open. So we did, actually, that was the right day to put the trade on, the 28th. That's the last chance to put a through the earnings trade on, right, for a stock that's reporting the next morning before the open. The last chance you have to put that trade on is the 28th. So let's get back to where we were going with that. So we're going to put the trade date here in the, I'm back to the Option Slam back testing tool. And we're going to put the trade date there. We're going to say 10/28/2024. Select that from the calendar that pops up, and then load strikes and expiration dates. Now this is end of day data. Same as Thinkorswim's Think Back tool, except our data is accurate. Be very careful backtesting in Think Back, because their data on Mondays is usually accurate, but the rest of the week is not. Be very careful, and I would encourage you to all call Thinkorswim and let them know that you're very upset with why their Think Back program still doesn't work. Since last November of 2023, it's been a year now, and it still doesn't work right. All right, so sorry, I'm triggered and very upset with them about that, if you can't tell. All right, so we're gonna select a combo. We got to push that button, click that button, that blue button, load strikes and expiration dates, and you get the closing price of the stock was 83.59 on the 28th. And what we ended up with, we looked at a few different strategies, but what we ended up with was a combination of a debit vertical plus a credit vertical. So what we did is we bought a debit put vertical. We're bearish, so we're buying a debit put vertical, what some might call a bear put spread, I think is what some of you call that. And then we also sold a bear call spread, which is a credit spread, where we sell a vertical on the call side. Both of them are bear strategies, and we can do that. We can choose from we can do it. We can go into here and do a vertical spread, but it's only going to allow us to do the long put spread. Okay, choose those, but that's all you can do when you choose that. or you can choose from vertical. You can say, or a short call spread, and you can do that by itself. You can do two back tests and end up with the same thing we had. Or you can go into here, choose combo, and come down here to custom setup. Custom setup allows you to do any back test trade up to 4 legs. Okay, so let's do that. Let's first do the buy the put. So let's go long. We'll just do one lot. Okay. And what we used was the 11-1, the end of the week. Yeah, we used the end of the week, the front week vertical. So we used the 11-1s, and we're going to do a, uh, uh, let's see, leg one, we're going to buy buy the 83. We're going to go, so here's what we did. Buy the 83. This is in last week's webinar. Buy the 83 put, okay? And then sell, same expiration date, 11-1, choose the expiration date from the pop-up, and then sell the 78, boom, also put. So there's the vertical spread, the debit vertical spread. Let's just double check it. Long, 11-1, the 83 put. Short, 11-1, the 78 put. Okay, looks like a vertical spread to me. Now we're going to do the other side. We're going to do the credit spread. We're going to sell, so not long, we're going to short, same expiration day, the 84, let's see, short the 84, call, perfect. And then the other, to finish up that credit spread, we're going to buy, yep, long, the same expiration date, 90, this is what we ended up with in the webinar last week, call, perfect. And then we click run trade, all right, run trade. And there we go. There's the results of the trade. Now I can download this to Excel. I can examine it. I can save it. And this is what I do all the time. Every week I use OSBTT, the Option Slam backtesting tool, to backtest trades that, and I've got a database where I save all my backtested trades so that I can analyze them and come to some conclusions about, what I did, what I could have done better, how well it worked, how well it didn't work, et cetera, et cetera. So this was done for a $6.50 credit. So you didn't lay any money out had you entered this trade. It was a $6.50 credit. Does that mean that there was no risk? No, there is risk. We're not going to get into the details of that now. I think we did last week, and you can go to our webinar archives to take that video in if you missed it. All right. So the very first day, the next day, by the end of the 1 day of trading, that trade was up $287. And by the end of the week, by the close of the end of the week, that trade, let's see, 77, was that max profit? I believe that is max profit. Yeah, 506.50. At 77, the stock closed at the end of the day, Friday, at 77. And our put was the 83, yeah, 78. So this was the perfect trade. This trade was just perfect. This maxed out just perfectly at maximum profit by the end of the week. Now the risk was about the same. I think the risk was about the same. The risk is, let me just illustrate what the risk is and how you figure that out. The risk is the difference between strikes minus the credit. So where was the biggest? 84 to 90 is $6 minus the credit was the risk. Okay. $6 minus the $6.50 credit. $6 times 100 is $600 minus this $6.50 was the risk. Okay, so anyway, there you go. There's a good illustration of uh, the Option Slam backtesting tool. These are all presets that you can use. And if you can't find the trade that you want to backtest, you can use our custom setup option here. All right, so let's go look now quickly at the website. And under the resources tab, the top selection there is Option Slam webinars. This is where we have the recordings of all the webinars, just like the one you're here and involved with and join me here today. And that's where you would go. Now, those recordings are available to our insider members. If you're not already an insider member at optionslam.com, just go up to this right-hand corner. I'm logged in, but if I wasn't logged in here, this would say join us. So if you're not logged in, and this would say join us, that's how you can become an insider member and get access to the Option Slam webinar archives, okay, found right here under the resources tab. Now, let's go over to our stock screener. Let's see what's coming up this week. And I'm going to hit my generic screener here, which looks for stocks that are reporting within the week, anytime within 1 week of today. It's also this. This is my presets. You can create a set of presets here, and then you can modify it on the fly. So this came up with, kind of a lot of events, 58 different stocks reporting that meet my criteria of stocks with weekly options, EVRs above 1, stock price above 20, and daily volume of 3 million. So since it's 58, I'm going to change it to, I'm going to just kind of tighten up here. I'm going to say, let's make the minimum price $30. Let's make the minimum volume 3 million and rerun that by clicking the submit button. And that took me from 58 down to 30. So pretty much cut our list in half. Okay. So let's see. A couple people said a couple stocks they're thinking about doing here. So George says TTD long calls. Let's see, TTD, is that on our list here? It should be. I just got new glasses, so things are still a little blurry. Okay, why is TTD not on our list here? Okay, well, let's find out. Let's do this. Let's do this. Let's go. Let me find another one. Palantir. I'm surprised no one wants to trade Palantir. Open link in a new tab. So I'm going to right click on Palantir. I'm going to open link in a new tab, which the new tab populates here. And now I'm going to go to, because we're not here, we're going to look for TTD. So first of all, TTD, when does it report? November 7th. So that is this week for sure. And the average daily volume is 2,800,000. That's why it didn't show up on the list. Okay, because I changed my criteria to 3 million minimum volume. So that's why it didn't show up on the list. So George is thinking about long calls closing before the report. All right, so George, I'm not a fan. It's a directional trade. The report is the 7th. Long calls, you're counting on two things when you buy a long call. So let's go look at the trade. If you don't mind, George, I'm going to critique the trade, and I'm going to also make a suggestion as how you could possibly improve it. Although, wait a minute, all right, let's go here. Let's go to, I've now brought up the trading platform Thinkorswim. So let's go to TTD, and we can see that TTD is definitely in a bullish trend overall, okay? Overall, TTD is a bullish trend. It sold off strongly into the last earnings event. Okay, recovered the last few days and then popped up at the earnings. So that's one thing I can see quickly right here. It is selling off again, similar to how it did last earnings. And we've got a few days to go, so it could pull this same repeat action, and that would be to your benefit. Okay, that would be to your benefit. Long calls, not specifying a strike, in the money, out of the money, I don't know. Long calls, closing before the report. So the idea with that concept is two things. You need, so let me just do an at the money call. Let's do an at the money call. And you didn't specify exactly how long out in time, but it's an earnings trade. I'm gonna just guess maybe either way, similar results. Um, I'm going to guess that you're going to give it a little time, but you're going to close before the report. Wait a minute. You're going to close before the report. Again, I think it would be advantageous to give it a little bit of time. In fact, maybe even more time than what I'm suggesting if you were to do that. But I'm going to try to suggest that that's not the greatest strategy because a couple things can go wrong. And I'm not saying it's a bad strategy, um, but here's what needs to happen. Let's go out to the November 15th, which is 2 weeks from now, basically. 2 weeks from now, let's look at buying the at the money call. Okay, you may have had an in the money call, an out of the money call. I don't know. I'm guessing here in mind. If you do this, let me delete these extra price slices up here. Delete that slice and delete this slice. Okay, so this is really kind of a gamble, right? It's a 50-50 shot. First of all, you have to be right about direction. And listen, there's nothing wrong with being directional. In fact, when you are directional and you have a directional bias, that if you are right about direction, that is the highest profit type of a trade you can get into. Non-directional trades, yes, they can provide very high profits. Delta neutral trades is another way to say that they can provide great profits. But a directional trade, if you're right about direction, is the best of any world, right? But of course, the downside is if you're wrong about direction, it's a definite loser. If you are wrong about direction, and between now and the 7th, and I believe TTD announces after the close, so let's take a quick look and make sure we're on the TTD page, and the event is the 7th after the close, right there, November 7th, AC. All right. So 7th. So we got quite a bit of time here. The 7th, if if I'm not mistaken, is let's go back to my calendar here a quick minute. And the 7th is Thursday after the close. So you only got until the 7th between now and the 7th, you need to close this trade based on your strategy plan. All right, so theta is working against you. Vega, which is I like to think of it as the multiplication factor for IV implied volatility changes, that is working for you. In other words, if we get implied volatility to increase between now and Thursday's close, the Vega factor is going to be the multiplication. So if we get, let's say we get 5 points of IV build between now and Thursday's close, that will be $40 improvement in value of your long option, okay, due to the IV increase. Now, what if we get 10 points? Well, then it's going to be $80. But in the meantime, you're losing $32 a day. Well, at least the first day. It gets worse as we get closer because the theta is not stagnant. That's a per day thing. It's going to increase the closer we get to expiration day, the bigger that number becomes. So you're really fighting a very strong and powerful force here, just being long options. I've done many studies on buying long options into an earnings event. And if you're right about direction, it's great. But even if you can still be right about direction and still not make money, because you need the price, you need the delta to overcome this theta decay. Okay, so for every dollar the stock goes up, you're going to make $51 plus the gamma factor, another $2. So that's about $53 in that. Now, let me suggest another idea, and that would be of course, it's going to cost a lot more money, but the zebra trade is a stock replacement trade. Okay, so if you were to buy this stock, and so I'm going to just propose an alternative idea that I think will help to neutralize all of this stuff. Okay, neutralize all of this stuff, and then the only important thing left is delta. All you need to do is be right about direction, and that is the zebra trade. So let's take this one. Let's look at the risk profile of that. There's the risk profile. By the end of the day, Thursday, if we fast forward this to the 7th, at the end of the day on the 7th, did that make a difference here? I'm not really seeing it. Let's see. Yeah. It's changing the today line. By the end of the day, the 7th, it says your break even. Let's see. And if I fast forward this to the 15th, just I want to prove myself. Yeah, that's good. That's correct. Yeah, that's illustrated correctly. So what this is suggesting is by the end of the day on the 7th, so I think I have to click the 8th actually to make that the end of the day the 7th. I think that's how this functions, this analytical software. You need to be up to, according to this analyzed software, you need to be at to 121.29, which is really not very far away from where the stock is right now. Let's see, 120. Where's the stock now? It's at 119.15. Okay, so you need the stock to go up to 121 and change to break even. So that's not terrible. That's not that far for you to hit break even by the end of the day Thursday. But here, let me illustrate the other trade. The zebra trade is the zero extrinsic value. Now, the zebra trade, I like to go further out in time. So I'm going to go, yeah, I don't like doing zebra trades that close with only 11 days to expiration. We can try it, and then we can quickly change the dates. So the zebra trade is buy 270 delta in the money calls. So here's my delta column. There's the 70. So I'm going to buy that. This is a stock replacement strategy. It eliminates all the Greeks except delta. So just like owning stock, this is owning stock without putting up the money to own stock, right? Because to own the stock would cost you $11,900, right? $11,900 to own the stock. So we're going to do this for a lot less money. We're going to buy 2 of those right there, buy 2 of the 112 in the money calls. Then we're going to go to the at the money calls and find the 50 delta. There's the 49. 121, that's a little, I'm going to go to the 52 and control key down, holding the control key and selling the 50 delta 120. Now, here we go. $1,555 is the debit. That's $1,555 is a far cry from $11,900. So for a fraction of the price of buying 100 shares of stock, you can let's look at what this looks like in our Greeks. All right, so yeah, that's a little bit of theta still in that, and a little bit of vega still in that. That's one of the reasons I like to go further out in time. So let's take this out to the December 20s, and now we are 150 delta. That's not. Oh, I have to take this one out to the here. I forgot to do this one too. I got to do them both. All right, there we go. December 20s. Okay. Doesn't quite neutralize. Let's see. Did I do this right? Oh, wait a minute. I'm going to have to change that up. All right. So I didn't like that. I'm going to start. Like I said before, I don't like doing it with only 11 days. So I'm going to go out to the December 20s. Now the delta, it's not going to be the same strikes anymore. Now I'm going to have to find the delta 70s. Here we go. All right, here we go. This will be better. This will be more like what I'm trying to get to here. So we'll go to the December 20s, and we're going to go to the 70 delta right there. We're going to buy 2 of those, and then we're going to go to the 50 delta. Oh, we don't have one right at 50 delta. We got either 55 or 45. Well, we can just try both. Let's try one. Let's try and sell that 125 at 45 delta. Now what we have is a very neutralized set of Greeks with a almost replication of what the delta of a long call would be. And if we look at that in risk profile, you can see that the today line, the purplish line, looks just like stock. Okay, let me unclick that and let's look at what stock would look like. Stock looks like buy stock. 100 shares of stock looks like that. Okay, do the zebra and you can see the purple line is identical to the buying stock. All right, let's just do a change here of that strike, that 125, and go down to the, yeah, not a lot of strikes available here in those monthlies. So that's why I'm having a little hard time finding the perfect 70 and the perfect 50 delta to create this strategy. So here is using the other option that we had, that was the 120 short call to create the zebra. That does a little bit better of a job, I think, replicating stock with the today line. Go to Option Slam webinars. Now, if you're not an insider member at Option Slam and you see some webinars there in the right here under research tab, if you see some webinars you'd like to view, just shoot me an email, optionslam.com at gmail.com, and I will provide you a link to view a couple, 2 or 3 of the webinars. You tell me which ones you'd like to view, and I will provide the links to you if you don't already have insider access to our site and tools and features and data, etc. So there is that, and let's move on to the other stuff that, let's see, we had, you're welcome, George. Paul says maybe a condor, iron condor on VRTX. So let's go look at that. Let's go look at that idea, an iron condor on VRTX. So Go back to optionslam.com. I don't think VRTX was in our list. So I'm going to go back to the trade desk earnings history page. And while I'm here at the earnings history page, I'm just going to change symbol simply by going VRTX. There's a lot of other ideas, George, that I think might be, directional. But closing before Thursday. All right, VRTX, let's see, why did that not show up? Okay, average daily volume, 1 million, okay, 1 million. So that's why it didn't show up on our list here of stocks here that came in our report when we queried the when we queried the stock screener here found under the earnings tab, okay? So here's Vertex. Let's take a look. We're on the earnings history page. What does Vertex usually do? 2 points, 3 points, 2, 3, 2, 3. Here's a 5% move, and here's a 9% move. There's a 9% move. So the EVR on this stock is currently a 1.5, so it's pretty low EVR, earnings volatility rating. Earnings volatility rating is, we at optionslam.com are the home of the EVR. We created the EVR, and we keep EVR on all of our stocks that we follow, even the ones that don't have options. Do qualify to have an EVR rating. EVR ratings, if you want to learn more about that, go to the help menu, go to EVR. Iron Condor on EVR. Well, the first thing I want to look at, excuse me, another drink of water here. I want to be aware of the options being priced in for a big move or a small move. Are the options being priced in expensive or cheap as compared to previous earnings events? When I'm selling premium, such as on an Iron Condor, I kind of like high implied volatility. I want to sell high implied volatility. And one way to check that is to go to our implied move weekly page and our implied move monthly page and compare what is the, this is today after the close. This is a today after the close is when this report. So today is the last day to trade this before the earnings event comes out. So I'm on the implied move weekly page here, and I want to see how is implied move compared, because implied move is is derived from the at the money straddle price. The implied move is right now at about, let's just round this up, call it 6%. I see that the implied move, the market is pricing in a larger move than previous earnings events. So see, there's all these previous earnings events, earnings release, ER I call it, and they are all lower than today. So the market, for some reason, thinks that the stock is going to move about 5 or 6%. Okay, and you know what? That might scare some people out and say, oh, well, if the market thinks the stock's going to move big and they're pricing in a larger than normal move, well, then I don't want to sell an Iron Condor because But on the other hand, another trader says, no, because I know that usually stocks move within their implied move. So if I have a large implied move, that means I'm going to get a little bit more premium for my Iron Condor, and I can at the same time have my strikes a little bit further wider than previous earnings events where the implied move wasn't as big. So it's kind of a little counterintuitive in one way, but if you really think about it, it does make sense that high implied move is not a terrible time to sell an iron condor, because we know historically stocks usually move within their implied move. And this chart up here is kind of the proof of that. Let me see if I can blow this up so it's just a little easier to see this chart. So you see this chart illustrates to you that the implied move is illustrated by this orange vertical bar, this orange vertical rectangle here. If you put your mouse over it, it tells you the implied move of this particular earnings event, the November of 2023, a year ago. The implied move was a low of 371 and a high of 401. These are just round, rough numbers, rounded to the nearest whole dollar. And what was the actual move? Well, that's that green candle inside there. That green candle tells you that the stock actually moved inside of the implied move. That green candle is in the theme of Japanese candlesticks. Green means it was open it closed higher than it opened, with an upper wick illustrating the high of the day and a lower wick illustrating the low of the day. So there you go. This is kind of suggests that the iron condor on Vertex would probably not be a terrible idea, because look at now this is only the 1 day move. We don't know what would have happened until by the end of that week if this was a early in the week earnings event like today's is going to be. Okay, we don't know if you would have held the iron condor until the end of the week, how this would have panned out. But you can go to our post earnings page and find out what happened beyond that. Or, of course, you can just go to the earnings history page and pull up a price chart and go back to a previous earnings event. Like here was the previous earnings, here's the previous earnings, and then just look at the price chart. So let's go and model that trade up at Thinkorswim. And the stock is VRTX. The implied move was 6%. Is that right? 6% was the implied move. And we'll go to the options chain. And let's see. Paul is thinking of a iron condor, not saying how far out in time. I'm going to go. Let's just model it up with the front week weekly. Okay, let's model it up with the front week weekly, and we can quickly change that date. So the 6% move, the stock is trading at 471. Okay, 471, and so 471. I'm going to have to let's see, 6%. Well, let's see how I can do this. 6% of 471 is approximately a $25 move. Thinkorswim does it for me. They calculate the they calculate the move to be about $26. So let's go 471 plus, let's round that to 470. Let's go up $25 to the 495, and we're gonna, here's the problem. Implied move, here's the problem. Liquidity is an issue here. This wide of a bid-ask spread is gonna be tough to get a fair fill on. Let me put this to delta, gamma, theta, vega, and let me add volume and open interest. I'm gonna have to do this with manually. I'm in my paper trader here, so it's not set up conducive to how I'm a little, let's see, open interest, let's add that, and let's add volume, let's add that. Let's take a look here now and see what we got. Open interest and volume. Okay, I have this preset in my other live trading platform. Let me save this. Let me save custom save as that. Okay, good. Now it'll be here next time we want it. I won't have to build it. All right, so let's save that. So we said 495. The problem I have here is very, very wide bid-ask spreads. We're going to build this anyway. Let's get rid of that VRTX. Wow. Huh. Okay. All right. So let's sell that 495. Let's go down 25 points. So that's going to be the 445. Let's sell that 445. And let's go out. I'm going to go $10 on this size of a stock. I'm going to go on the 445. I'm going to go out down to the 435. I'm going to buy that. I'm just simply creating a iron condor manually here, and I'm going to buy that. So let's look at that. Iron condor. Okay, so I did it right because Thinkorswim recognized that as an iron condor. It's 10 points wide. It brings in a credit of 470. Now, what we need to look at here is, are we collecting enough premium to justify the risk? So the way I'm going to do that quickly is take a look at what is the risk. Well, the risk is the difference between strikes minus the credit. The difference between strikes is 490. It's $10. I'm sorry, it's $10. $10 was 505 to 495 is $10. Same on the other side, 445, 435. $10 is the risk between strikes. Is the difference between the strikes minus the credit. So definitely this models up, and we are collecting well over a third of the risk to reward. Is we're risking less than a third to the reward. The risk reward ratio here is very nice, actually. It's a very good iron condor. So the only thing is, of course, we do have risk, and the risk is this $563. So we're risking $563 to earn $437. Okay, so it's a good. Let me reset this. I see something that doesn't look right. Reset parameters and date. There we go. All right, reset. Doesn't change this at all. Okay, so hey, you know what? If you could get filled on that at that good price, that would be wonderful. I just highly question whether you can get filled on that one. I don't know that you can get filled with those bid-ask spreads as wide as they are. All right. So hopefully that was helpful. And okay, anybody else? All right. I don't see anybody else with any other trade ideas typing in. Last, speak now or forever hold your peace is the saying. Let's go back to our option screener and look at our report and see who else came up on our report. Now, I want to PLTR. Let's take a look at PLTR. This is really in the news a lot. PLTR, let's go to open that link in a new tab. I just right click on that, and let's take a look at what PLTR, the implied move. I want to see what the implied moves are here. Now I got 13% is the weekly and 14%, almost 15% is the monthly. So those are, you can quickly see what the implied moves are without even scrolling down to the table. But I want to scroll down to the table because I want to see what previous implied moves were. All right, so previous implied moves, 13 to the current one right now is 13. Last quarter was almost 15, 15, 15. Here's a low end one, 11.8, about 12, 15, 14, 14, 15, 13. So we're about in the middle. We're about in the middle of the history of implied moves here, but we're certainly not at the high end. So I think it might be okay to look at a ZIMS trade. A ZIMS trade is the 2 times the implied move trade. I don't know what this is going to look like. I haven't modeled this up in advance of today's webinar. I'm just going to look at what would it take to put on a ZIMS trade. That's 2 times the implied move. So to do the two, now all of these strategies like the zebra, the ZIMS, the risk reversal that we looked at in PayPal earlier, these are all detailed, where entire webinars were spent on the ins and outs of these strategies. And again, the Option Slam webinar archives, if you scroll back and you want to learn more about the ZIMS or the zebra or the risk reversal or butterflies or iron condors or whatever it is you want to learn more about, there is certainly at least a couple, 2 or 3 webinars on each of those strategies, maybe many more. Let's look at a ZIMS trade. So quickly, we'll jump over to Palantir, PLTR, add simulated trades. Now, with the ZIMS trade, spelled XIMS or ZIMS, spell it however you wish. I like to go, I first want to determine what is the implied move. Well, we already know it's 13%, okay? So 13% of the stock price, which is currently at $42, is about a $5 move, $5 to $6 move, okay? 13% of the stock price is a $5 to $6 move. So what are we going to do? We're going to keep that in mind, and we're going to double it, okay? We're going to go 2 times the implied move. We're going to say that's somewhere around $10 to $12. And we're not going to use the front week weekly. We're going to go out a week in time, okay? We're going to give it just a little bit of time to work so that in case there's what we commonly call a post-earnings drift. In other words, after the earnings is out and then there's the one-day move, then what are the subsequent days? Does the price continue to drift in the direction of the one-day move? Does it continue to move up if it's a positive result? Or does the price of the stock continue to move down if it's a negative reaction to the earnings? So that's the post-earnings drip. Drift, not drip. So 10 to 12, we're doubling the implied move of somewhere $5 to $6. We're going to double that. Let's call it $11. Let's call it $11. Stock's at 42. Let's go up $11. That's going to take me to the 53. We don't have a 53, so we'll use the 52. And we're going to use, it's a 2 times the implied move strangle, ZIMS. The S stands for strangle. So we're going to buy a very cheap, far out of the money call, which is 2 times the implied move, and we're going to buy it 2 weeks out in time. We're going to buy that call, and then we're going to go from where we are here, 42, down to 32, 31, and we're going to buy that 31. Control key down, buy the 31. So for a mere $65 risk, that's all there is to the 2 times the implied move trade, the ZIMS trade. And this is a very low debit, and it has a very low probability of profit. If you put on lots of ZIMS trades, you're going to find out that most of them lose money. But when you hit a winner, it can be a huge winner. Sometimes these hit and you can make 1,000%, 2,000%, easily 100%, 200%. big numbers, and one big winner on a ZIMS trade pays for many small losers. So let's look at this in a risk profile. Okay. And let's add the implied, let's see, we're doing out to the November 15th. So let's look at the one standard deviation out to the 15th. So you can see the one standard deviation suggests a move out to $48 approximately and out to $36 approximately. And this particular trade is subject to implied volatility crush. That is and negative theta as well. So let's delete that slice and let's delete this slice. And let's look at just the one at the money slice. So we can see here's price in the middle and a move up, okay, or a move down brings in profit. A non-move, a move like an iron condor likes, is not much of a move at all, would result in a loss of the probably most of the entire premium. But this trade does have some time. There's 2 weeks of time available here. Let's go back. Again, low probability of profit, but when it wins, unlimited potential for profits in either direction. Now, do we expect the stock to go to the moon? I don't know. Let's go back to optionslam.com and let's take a little deeper look at what's happened in the past. We like to let history kind of guide us towards what might happen in the future. So let's go to the implied move weekly page again here at optionslam.com. And what's happened in the past? Well, just like we know, price usually moves inside the implied move. We would not want that to happen with a ZIMS trade, but occasionally price can move outside the implied move, like in this case, and in this case, and in this case, and in this case. I don't even see this one. Where's this move here? This is outside the implied move. Now, none of these moves outside the implied move are sufficient for a ZIMS trade to make a ton of profit. Not in the first day, but don't forget there is what we call the PED or PEAD, post earnings drip. So let's go and see what happened subsequently to the earnings event by going to the post earnings page. Remember, we've got 2 weeks. So when we come down to over to the post earnings page, we can look out. The 1 day move was up 10%, but within a week, the stock was up 26%. I'm going to tell you that that is more than enough for the ZIMS trade to have worked out last quarter. The ZIMS, and since we're going out 2 weeks, guess what? Last quarter, if we would back test this and go to the 30, and the stock moved within 13 days, almost 2 weeks there, 33%, this definitely turned into a big winner. You know what? I can't wait to see the results for that. Let's quickly do it. We can just back test that, make sure that we're not full of beans here. Let's go to OSBTT again, open that in a new tab. Let's take a note of when that last earnings date was. It was August 5th after the close. Okay, so we're going to go to stock symbol PLTR. We're going to go to 08/06/2024. Select that date from the calendar and load strikes and expiration dates. Now, I need to make sure I got that date right. Wait a minute, August 5th, 2024. I got that date wrong. Let me change that back to the, open that calendar, August 5th, 2024. Now load strikes and expiration dates. Okay, now I got August 5th, 2024. Select a combo. We're going to buy a strangle. We're going to back test this, and we're going to buy the strangle. What was the implied move? Well, that is information that we can get right here from optionslam.com. go back to the front week weekly right here, and the implied move weekly, and the implied move was last in August 5th, the implied move was 15%. Okay, so let me, I'm going to just use this calculator here. Where's my calculator? Right here. So the stock was, you know what, I'm going to bring that, what was the stock? I don't know. Let's see, the stock was $24. $24. 24 times 15% was the implied move. It was a $3.60 move. So let's add 350. Let's do it that way. Let's go back to our okay. So here we are on August 5th, buying the long strangle. We're going to go out not to the front week. We're going to go out. We're going to back test this just like I showed the live trade for us to think about today. We're going to go out 2 weeks to the August 16th, and we're going to add $3.50 to the price of the stock to choose our strikes. The stock was at 24, so we're going to go up 350 would be 27.50 to the call side. There's the 27.50, and down 350, that would be the 20.50, which I doubt we're going to have that. No, we do have it. We actually do have it. The 20.50, 21, 22, 23, 50, 24. Okay, so there we are with that ZIMS trade from last quarter. Okay, what would that have cost? Well, let's find out. What would we have had to pay to buy that? Click Run Trade. And, ooh, it says $159. So that is a little surprising to me that it would be, wait a minute, no, I did it wrong. I forgot to go 2 times. Let me change this. 2 times the implied move. The implied move was 350. Okay. This is a through the earnings strategy. And this is put the trade on before the earnings. So I forgot to go 2 times. So the implied move was 350. I need to double that to $7. So the stock is at 24. Okay, right here, 24. So I went out 2 weeks. So I need to go 24 plus 7 is 31. Right, 24 plus 7 is the 31. Okay, 2 times the implied move. I made the same mistake a couple webinars ago. And 24 minus 7 is going to be the 17, right? 17, 24, 4, 5, 6, 7. Yeah, 17. All right, now let's run that trade. Okay, I'm glad I caught that because that looked. Oh, I made the mistake last time. It was on Netflix. That was a couple webinar. That webinar was a couple 2 or 3 weeks ago. I made that same mistake, and the actual debit was a fraction of what I had illustrated in the webinar. So, but I corrected it in the following webinar. Here we go. Now this is more like it. Risking $47. So what happens if you, well, I'm surprised that this didn't do better than that. It only makes $60, and that's only if you hold it all the way to the October 16 expiration date. It did turn out to be a winner, but it made what, 150% on risk, basically, about 100 and some percent on risk. Made $60, risking $47, but it really suffered from implied volatility crush on the way to finally making a nice profit. So there you go. Thanks everybody for being here, and I'll look forward to seeing you again in the next webinar. In the meantime, don't forget, you feel free to email me with any questions, comments, or suggestions over there to optionslam.com@gmail.com. Look forward to seeing you in the next webinar. In the meantime, wishing you all good trading.